In this kind of crazy economy, everyone's on the hunt for stable, high-yield investments. But what if I told you one of the hottest assets right now isn't some flashy tech stock, but the humble self-storage unit? Yeah. Today, we're digging into why this often overlooked corner of real estate is being called a full-blown gold rush.
Close to risk-free. I mean, just let that sink in for a second. That's a huge statement, especially coming from a source like CNBC. But that's exactly what they said in a report just this month. So is that just hype, or is this the real deal? Well, in this explainer, we're going to tear that statement apart and see what the numbers actually say. All right, so here's our game plan. First, we're going to tackle that risk-free claim head-on. Then we'll zoom out to see the national boom that's happening. From there, we'll dive deep into a really fascinating case study, the Indianapolis market, look at some actual deals, and then wrap it all up with a clear action plan for anyone thinking about getting in. So, what's the secret sauce here? What gives self-storage this incredible reputation for stability? Well, while office towers and retail centers need a booming economy to thrive, the demand for storage, well, it's driven by something way more basic. It all comes down to what the industry calls the 4Ds: divorce, death, downsizing, and dislocation. Now think about that. These are not economic cycles. They're life events. They happen when times are good, and they happen when times are bad. This creates a customer base that the source says has zero economic correlation. And that's the absolute key: a constant, predictable flow of customers, no matter what the stock market is doing.
So that rock-solid foundation has led to some pretty jaw-dropping performance across the country. Let's pull back and take a look at the big picture for the U.S. market. And this is not some new fad. We're talking about 15 straight years where self-storage has delivered higher growth in net operating income than any other major type of commercial real estate. That means it's beaten apartments, warehouses, office buildings, you name it, consistently for a decade and a half. That kind of track record is, frankly, impossible to ignore. So what's going on right now? Well, it's basically a perfect storm for an investor. First, property values have actually dipped about 11% from their recent peak, creating the best buyer's market we've seen in 10 years. Second, the business itself is just incredibly profitable, with gross margins hanging out around 60 to 70%. And third, the big guys, the REITs, are sniffing around and starting to buy up smaller local facilities. Now, if the national picture is already looking this good, believe it or not, some local markets are even hotter. And according to our sources, one of the real gold mines at this very moment is Indianapolis. So let's find out why this one city is crushing it. It really starts with one thing: the return, the cap rate. Nationally, you'd be lucky to get a cap rate around 6.5%. But in Indianapolis, we're talking a range from 7.2 all the way up to 9.1%. That's not just a little better. That is a massive difference in your bottom line. And it's not just potential profit, it's actual real-world demand. Indianapolis is sitting at a 92.3% occupancy rate across the entire metro area. That's the highest in the whole Midwest. It means the buildings are full, the rent checks are coming in, and the income is super reliable. So who owns all these places? Well, this right here is the golden ticket. A whopping 68% of the market is still owned by local mom-and-pop operators. The market is fragmented, and that means it's ripe for a smart investor to come in and buy properties, often off-market, directly from owners who are just ready to retire. And you can get even more surgical than that. Just look at the different neighborhoods. You've got a place like Fishers, which is booming with young families. Then there's Carmel, where the story is all about boomers downsizing. But check out Avon. It's getting spillover from a growing industrial area and has the highest cap rates of them all. Every single neighborhood tells a different story. Okay, all this data is fantastic, but let's make it real. What does this look like when the rubber hits the road? Let's check out 3 recent deals that show you exactly how this playbook works in the real world. So here's the strategy in action. In Fishers, an investor grabbed an older facility off-market and immediately boosted its value by adding modern stuff like climate control. In Avon, they bought an entire 3-property portfolio from an owner who was ready to retire. That's that mom-and-pop opportunity right there. And in Carmel, they got creative and turned a dead big-box retail store into a thriving modern storage facility. So what were the results? Well, let's just focus on that Fishers deal for a second. After buying the place and making those upgrades, the net operating income shot up by 28%. Not in a year, in the first 90 days. Just think about that. That's the incredible power of this strategy. All right, the opportunity here is pretty darn clear. So let's wrap this all up with a quick hitter Q&A, answering the most important questions you'd have if you were looking at this market right now in 2025. First up, the classic real estate question. Is it better to buy something that's already there or build something brand new from the ground up? And the verdict from our source is crystal clear. Buy existing. With land and construction costs so high, the smarter, faster play is to scoop up these facilities at those awesome 8 to 9% cap rates and then force the value up by modernizing them. Okay, next up, every market has pitfalls. So what's the number one mistake, the biggest tripwire you need to avoid in a market like Indianapolis? The biggest mistake is getting distracted by the flashy new developments and completely missing the real treasure hunt, which is finding those local, off-market deals with longtime owners who are just ready to sell. That's where the real value is hiding, not in a bidding war with the big national players. And the last, most critical question, probably the one on everyone's mind. Is it too late? Did I miss the boat? Have the big Wall Street firms already taken over? And the answer is no, but the clock is ticking. The big institutional money is definitely circling, but they haven't taken over yet. You see, most of the deals under $10 million are still too small to even show up on their radar, and that right there, that is the sweet spot. That's the window of opportunity for independent investors to get in and win. Which leaves us with one final, pretty provocative thought. In a market like Indianapolis, where Main Street owners are still the majority, but Wall Street is getting closer every day, are we watching the last great chance for the little guy to buy a piece of the action before the big money takes over for good?